So, after last week we designed our beautiful launch vehicle, then today it's time to see that what is the added value of this. So practically I would like to show you that how can we design a discounted cash flow valuation, what can be the pitfalls here and there in practice, and also after that we will see some further implication, and also we should write the first report about our findings and added value and problem identification and so on. So this is today's job. Okay, so if we are checking CoSpace, and from last week I uploaded all the Excel sheets, so you can find the sample, my solution, and also this is the default setup, so original company without any modification, just the terrible profitability, and this is the sample solution for case studies in finance and investment, and 0.1. Obviously this is not for the same course, so that's why we should rename it, and I should remove this one. Once things are passing at that class, then they are implemented here, so you are always getting the tested and updated version of everything. So, sample solution for international financial management. Yeah, this is the case study name, this is my name. Obviously your names should be here, and the year doesn't matter. Okay, so first of all we have to identify problems, and obviously we need a motivational quotation, because if we are creating any business plan in our modern world, we need something. So obviously we have to make the world a better place, because otherwise companies are not existent and not relevant. So after that, by utilizing oxygen and hydrogen at orbital speeds, practically doesn't matter. So it's up to you to make your own slogan. This is mine, and it's so beautiful and so meaningless. Okay, so as you can see here, first it's easier to start with the initial problem. So it's always nice to introduce that what is the problem to be solved before we are starting to provide solutions, because obviously it's identification of the steps is necessary, and the motivation. Second step, product design, what you have done, just in this case with some nice description, and after that profit and loss statement, and then this will be continued by valuation. So this will be the last step. Okay, so let's go through the problems. Can we identify more or less? So this is a French company. This is alone can be a problem, but right now this is neutral for us. So hopefully they are not going to strike immediately. And privately owned enterprise. Okay, this is for the case study a problem, because we are not able to dig in enough data. During the case study, we are assuming that it can be operated also as a publicly owned one. This is providing orbital launch services. Cool. To global customers and the ESA. Yep. And this is our assumption. So, added value here, that we are assuming that we are buying a nice package in this company. So we are buying ourselves in next to Airbus and Safran, and as a venture capital fund. So practically venture capital funds has always this 5-year long investment horizon. So usually this is their average time. So venture capital funds are operated for 10 years. They are closed-end funds. So at the beginning of the 10 years, they are collecting the commitments. And whenever they can find a nice company with potential growth, so they are always looking for growth potential, in terms of corporate valuation. Then they are collecting the committed funds from their investors, and after that they are trying to do their best for 5 years. If they are successful, then they can sell the company. It can through IPO, it can to another company. So maybe they are just selling it back to Airbus and Safran at the end of the day, or they are just listing it on the stock market, or they can choose a SPAC, which is practically a nice interpretation of IPO. We will talk about it later when we will talk about funding. But at the end of the day, we have to exit somehow. If they are not able to sell it, if they cannot see that there is a viable exit strategy by selling the shares, then this is the liquidation exit, when they are just selling all the assets, all the patents and so on. So they are closing the company and they are trying to recover as much money from their assets as possible. So hopefully we will have the first kind of exit when we have nice profit at the end of the day. So we have this package here, and for 5 years it's good because our entire valuation and the entire case study is also 5 years ahead. What a surprise in terms of planning. And yeah. Okay, so the key problem is the company absolutely lag behind the competitor. There is one competitor right now. Just the problem is that if you are checking the market, so yesterday already a Chinese company was able to demonstrate that they were able to land their first stage just after a 10-kilometer hop. So they are already far ahead of us. Or also Jeff Bezos would like to. So Jeff Bezos has this, you know, the Amazon guy, has this really phallic-shaped suborbital launch vehicle, which is bringing up space tourists and back to 100 kilometers. So practically this is suborbital. So they are not being launched to orbit. Whatever they are launching, it comes back several minutes later in one piece, at least until today. So they are doing it for several years now, and they are building their monster rocket in Florida. So they're supposed to launch it originally in September. Obviously, they will not do it in September. So right now, the expected date of launch of their orbital class vehicle will be in October. But the whole design was based also on recovery of the first stage. So, yep, this will also cut the market because they will be a new market participant and with infinite amount of money. So come on, Jeff Bezos is practically printing money with Amazon. So this is our niche case when we can still survive and maintain some market niche if we are not doing anything right now. So, and also there are other companies. Terran Air they built a huge 3D printer to print the whole rocket from scratch metal, so from metal powder. So it's a huge 3D printer with lasers and so on, but if I know well, they are close to default, or defaulted, or they will be purchased by some competitors. So right now it's not clear what is happening with them. They had one launch, but it failed. So that would be a potential competitor. So yes, we can say that absolutely we are lagging behind in terms of technology. Not just the 5. That was 4. Now it's 5-year delay, but unable to land its first stage to provide rapid partial usability to cut expenditures and to increase market. Okay, so partial usability means blah blah blah. Here I just defined that what is the meaning here. So we are aiming to recover the majority of the launch vehicle. There was a question that how many engines do you need for the second stage? Since most of the heavy duty is made by the first stage. So you have to lift up the stuff from the ground up, and until that you have to carry it around 60 to 70 kilometers. And after that you can release. But at this height you are nearly above the atmosphere. And also you are reaching close to orbital speeds. So practically this is where you need all the fuel, or most of the fuel, and most of the engine capacity to lift up all this fuel and weight. So after that, second stage only uses one engine. There are only rare cases in terms of Centaur, which is quite an old legacy hardware from the 60s, where they are using two engines, but this is for Mars missions and for other far distant places in the solar system. So practically one engine is completely enough. It's also good because in this case we can, yes?
Like the previous example, we have the total three engine. We distributed into the first stage 2 engine, and
yes.
The second one is
yes.
1 engine.
Yes.
But if we have 10 engines, so
yeah.
how are we going to distribute it?
The same way, that one engine goes on the second stage and 9 on the bottom.
Okay, the same way.
Yeah, the same way. So in this case, it means that engines alone, they are weak. And also during landing, it's much better if you have multiple engines, because in this case, you are just using 1 or 2 engines for landing. So you don't have to use up all your engines for all the times. It's much more redundant, practically, that you just have to be able to run up or spin up 1 or 3 at most. So it's more robust also. When one fails during launch, then still the rest can carry them. Yes?
Okay. In the beginning you said that I didn't understand what you said, that our venture capital from projects.
Yep.
At the beginning.
Yes.
Yeah. I don't understand that.
Which part?
The venture capital from projects.
Yeah.
7 shares.
Yeah.
Who are they partnership with? How did they buy the shares?
Oh, we will deal about this when we are talking about funding. So right now we can say that this is how we are engaging with the company. So that's how we can measure that if the original pricing is happening right now, then we are buying the shares at the current fundamental value, DCF value, and then if we are implementing the project and the improvement of the company will be successful, then the share price will increase by this. So that's the reason why it was easier to show and highlight the added value of the project, and we can say that, okay, capital practically increased because what we invested. Yes?
For example, here, we have 10 engines.
Yes.
So what happens if you use 5 on the first stage and 5 on the second stage?
It will not work because it will be way too weak to lift off anything from ground. So we have a nice birthday candle which will burn up the fuel but not moving upwards. So that's one small problem. You have to concentrate them in the first stage. If you are designing something like this, then you can still resubmit it as a comment at CoSpace. Okay. Okay. So. Yep. After that, we can go to the next thing. So product design. So we are using legacy hardware. Practically to land our vehicle, we have to be able to throttle down the engines. So unfortunately, from engineering point, usually these engines are spinning up to 100% of their thrust, and after that just happily running at 100% until they are running out of fuel. So that would be the traditional thing. The problem is that during landing you have to slow down nicely. Nicely, I mean slowing down by 4Gs, 5Gs, but still survivable even for a human. So you have to throttle down, land nicely. So practically the engine must be able to survive at 60% of its performance, which is this is the hard part. So that's the part where they have always cooling problems. The engine can burn itself through. So this is the technical part, but we are not engineers, we are economists, so engineers will solve this after some nice explosions. And so we are using legacy hardware, at least in my case. So obviously you can write here different things. We don't use solid rocket boosters because this cannot be recovered. So that's why I'm using 2 engines from this one, because in practice 2 engines are not that great for landing, so because it's not symmetric. You have to ignite both of them in synchronous order, so it can topple in different directions, but still it's an engineering problem. It's not mine, so I'm using 2. Okay. So I will highlight it by yellow, that for your case you can, or you should change it. And practically all this. Therefore I will use what I'm using. Let's see the product. Practically let's copy all this. So therefore I will still use the Vulcan 2.1 first stage because it's modernized, and 1 second stage, because in this case we are just losing 1 engine and it's good. The rocket body is manufactured from, no, not from the traditional, we are using carbon composite, or the, sorry, the first stage. Manufactured from carbon composite. Yep. So this can be also different in your case. Okay, and that means the fuel must be something for you. For me it's liquid hydrogen, which is the worst possibility. Theoretically I could feed liquid methane into it, but okay, so let's use the legacy fuel. Corrosive, low temperature, it provides all the leakages. So the most terrible thing, but this is the most efficient. So it has its meaning. So the reusable vehicle will cost some kind of a money for manufacturing. It's so cheap. So 91 million euros to get fueled, manufactured, and this will be your unit cost. And some of this, practically majority of this, will be recovered from its first stage, can land, and the remaining euros will be expendable. So we are losing money. So this will be burning up in the atmosphere, and the rest will drop in the ocean. So there is always a part in the Pacific Ocean where nobody lives, in the southern hemisphere, and usually they are dropping stuff if they are able to achieve it. If the engine can be relied on and it's not falling to pieces already in orbit. Yeah, it can survive 10 launches, which can reduce our engine manufacturing needs from a lot to less. What is the data for that one? Well, we don't need this number, so I needs end of sentence. Obviously, in this case, the highlighted parts should be written by you. We can assume that the first stage can survive. Yes. Hazardous nature of live testing means that in the first 2 years of operations, most of our first stages will not survive their landing attempts. So mostly they will go up, just down, not in one piece. Yeah. Yeah, first stage is stupid, so we have to add all this. Okay, our launch price should be under... No, it's not under. Ah, it's under. Oh, sorry. Should be under this level, so... Then competitiveness on large market, so we will ask 59.99 millions for each orbital launches, regardless it's new or flight-proven hardware. And still, I don't have to modify this graph here because it has the same number, so it's good. Okay, then we have to talk about our profitability because we are economists. So, profit and loss statement. So once our launch vehicle defined our unit costs, launch prices, launch numbers, then we can focus on our profit and loss statement. So revenues must be divided between US dollar and euro, since yeah, that's also new information. So Kuiper satellite internet constellation. So let's go to Wikipedia. So obviously, since Amazon is the leader in cloud computing and cloud storage and all the cloud market, then they realized that once Starlink started to provide satellite internet for their clients, now they have Starlink has more than 4,000 satellites and more than 2 million clients. So Amazon realized that they should keep up with all these things. So Jeff Bezos funded also Kuiper, and practically they would like to do the same thing. So satellite internet with a huge amount of, we are talking about thousands of satellites at low Earth orbit. So in this case, the lag in the movement of data will be minimal. Nowadays, they are also talking about that even traditional phones should have some kind of connectivity. Starlink started to demonstrate this thing, but mostly everybody is focusing on text messages or low bandwidth, because obviously this phone should reach up to 600 kilometers or 400 kilometers sometimes. So obviously in this case the cell phone tower is far away compared to the current land operated one, which is maybe in the next year. So Kuiper Systems was originated and created, and they want to deploy a constellation of 3,000 satellites in orbit. But this one is a publicly owned company by Amazon, and one shareholder created a lawsuit against Amazon that they are not using their funds efficiently, because obviously they did not want to use SpaceX services, because come on, this is the arch enemy. So Bezos and Musk doesn't like each other personally, and so at the end of the day, what happened that they purchased launch numbers from the United Launch Alliance, so from the Lockheed Martin Boeing subsidiary, from Ariane Group, Blue Origin, from Bezos' other company. But as a result of the lawsuit, then also SpaceX had to have some kind of share from the cake. So now there are 4 companies. But luckily we have some nice ordering, so we can see that 18 launches will happen within the next several years, so during 2025 and 2026. And it's good. Just as the result, we will have also currency risk, currency exposure, because obviously they will pay us in US dollars. So, which is good, because somehow we should build in also exchange rate risk to manage exchange rate risk at the end of the day in the case study. So that's why we can see okay, so in the following fiscal years we have this situation, and so you can see that still in the future we have to solve this one, because right now we don't have unit price in US dollars. Why we are more expensive? We are just taking advantage of them, or I was able to find some price. User terminals, facilities, launches, pricing. Or we are just expecting that so maybe that can be the reason that originally Ariane 6 was priced at 70 euros, so this can be the reason why I tried to include this one. So first of all, we have to modify the balance sheet with this data, not the balance sheet, sorry, the profit and loss statement. So my sample, sold goods, probability of gaining revenue. So this part we should just ask downwards. How many of them? Unit price in USD, that's one thing, and USD revenue, then one more. Sorry, a number of sold products should be also added. So we should add 3 different. This one. Oh my. I destroyed my formatting nicely. Okay, so expenditures will start here. Oh my god, this is profitability, so this will start here. Just some housekeeping that okay, so US dollars. So number of sold products. It's good because if we can do this later on, so we can see that this is a high order number. If we can do this later, then it means that we can reuse the first stages. So it generates lower amount of expenditures if it happens in the third year when we can reliably reuse the first stages. So it's good for us not to say that, oh, let's immediately use up everything, because that will just generate expenditures for us. Okay. So right now exchange rate is 1 to 1. I don't want to. This number multiplied by this number multiplied by the probability of gaining revenue. Yes. Okay, it's in euros, so still we have to multiply it with this number, and this number must be fixed. This is not a percentage, so what? Dun, dun, dun. Yay! Okay, so now we should cut back number of sold products in euro, unit price in euro. The rest is good. So now we should reduce this number minus this one, because this is happening in US dollars, and also this number minus this nice juicy US dollars from Amazon, and then we can say that okay, the revenues must be added, revenues are added, and now we have currency exposure in our book, so at least in terms of profitability. Also, if you are importing engines from the US, so it's when you are not using legacy hardware but some US one, then similar thing will happen in the future with your profit and loss statement as well. Just in this case, you don't have to cut to euro and US dollars, because at the engines everything will be US dollars, so you don't have to add further rows. Yep. And unfortunately, in this case, inflation will not affect us. So we already made the contract, so this is what it is. So inflation will be neutral in this case, which is sad, but we asked way more money than for our European clients. So Amazon will survive if they have to pay more. Okay. Why it's 91? It's not supposed to be 91, this is supposed to be this price here. So, product A9. Product. Sorry, this is the manufacturing. Okay, yep. Sorry. Unit cost, okay, then it doesn't matter. Yeah, so we just have to copy. Copy all this. And give some nice formatting. Original versions formatting was nicer, but yeah. Okay, so all expenditures are defined by the recoverable and expendable components and wages. The maintenance of a launch complex is completely ignored due to lack of data. We don't have any maintenance data, unfortunately, so it's just happily existing, or is part of the wages. Or I don't know what happens there, but okay, so we don't have data. Somehow we are employing such amount of people, because I was able to find the number of people who are employed. And in this case, I was taking just the gross average salaries in France, multiplied by 2 because they are more expert people, and then we have the annual wages. So obviously we can't fire them because we don't know that who is essential and who is not. Okay, at SpaceX they are usually firing 10% of their manpower regularly, so after several years they are doing this cutting, but let's not do this. Anyway, we don't want to be profitable because we are firing people. We would like to be profitable because we can earn a lot of money. Cut their wages. Yeah, so we are not Unity Launch Alliance to cut wages because this is what they did. Inflation is represented both in our revenues and expenditures since we are operating at an oligopolistic market. We set everything to oligopolistic, so inflation is just rolls through the company. Since still there is a limited number of companies everywhere, so cost competitiveness will depend on reusability of the first stages. Yeah, since we have to manufacture lower amount of steel. Okay, so expenditures, we have to add everything. Ding, ding, ding. Yeah, there is. What? Okay, so still coloring can be an issue. Okay, now we can see everyone. Good. We will have losses only in the first business year, do we? What happened here? Okay, revenues minus cost of sold goods minus wages minus depreciation. This is my setup. Okay, so we have over losses in the first and second business year. So this is also what should be modified by your description. Then the company turns profitable due to high launch numbers and gradually reduce manufacturing needs. Since I'm building a Ferrari of first stage, then obviously I will suffer in the first 2 years. And we are conservative during planning about future launch numbers in the 4th year and 5th business years. Yeah, this is when I should also talk about satellite market. So usually if you are going to a satellite manufacturer, then usually it takes 2 to 3 years until the manufacture process ends. So they have there is a lack of capacity to build satellites, and after that still there is a way or 1 or 2 year waiting list until your stuff will be launched in space in many cases. If it's a small satellite, then or CubeSat or still a small one like a fridge, then usually it's easier to launch within shorter time periods, but still testing and other things takes time. So that's why we can say that we cannot see the market ahead for the 4th year and 5th year completely, because many of the potential orders are not created. So they are manufacturing it, they are not sure that they can launch it in time or not, or they will finish with the manufacturing process or not. So that's why it's has an uncertainty. Okay, pre-tax profit can be under assumed for this period. Okay, the company will not pay any dividend in the first 2 years. We are not paying it. Practically, I don't want to pay anything, so the company will not pay any dividend. Because all the profit. That profit will be reinvested into our cash reserves to generate a nice amount of money in the last year. Nice. 2-2. Not that nice like before, but in the 4th year. So we can earn some money. So let's copy again the profit part. Okay, so we are using the following interest rate and foreign exchange rate parameters during the case study based on actual market data. Do we? Interest rate on debt. BBB. Okay, now it's not BBB, it's just simple B. It's so strange that they redesigned. So you can see that in the spring semester it was still available, it was available for years, and now it's just not there anymore. Okay, interest on savings, French government bonds. This one. At least you don't have to modify this one, so it's the same for everybody. Euro in USD rate. Oh, we have to dig up this one. Right now we don't care about that. We will solve this. We will do this in the future when we talk about the FX risk. I don't want to care about this one right now because it will be at a different seminar date. Okay, inflation. Inflation is smoothing out nicely. Lending rates. Also, we will define it once we are at funding. Because in this case, we will compare the different funding conditions, so obviously we should wait until these things happening. So, now we did all the valuation. So, now it's time to focus. Okay, let's define second level template. Okay, so as we can remember from the lecture, we have to go through the following steps. So first of all, we have to define the free cash flow. Generation. Can we generate cash or not? If we are not able to generate cash, then we should close down the company. Then other thing is weighted average cost of capital. Discount rate for the FCF. So this will be the second step. And in the future, so this is the salvage value. That's all. So, obviously, the motivation here that we would like to be valuable because of we can generate cash instead of being due to our assets. So, because if you are comparing the two case studies, so if you are opening both Excel sheets at valuation, let's bring this one under that one. Come on. We need more space. So here we can see that practically the company was not generating cash at all in the original setup, in the expendable setup. Here now, okay, we have some issues, but at the end of the day, still we can see that you can ask the question that why this one is positive. The reason is that floating capital was increasing it because floating capital already contains the amount of cash what we were able to collect from debt-related funding. So I was taking up, not the thinking about the loan, so I was issuing the corporate bond as one potential financial or financing way. Then later we will test when we will talk about funding alternatives. But already we have the cash reserve, so that's why floating capital is high, and that's why even if this is negative, then this will be positive. So only the free cash flow will be negative only in the second year because we start to burn up our reserves. but after that we can see that we start to generate money again. So this is the sad reality, that we have to survive the first 2 years without any additional failures. So just the failure should happen, which is probable, counted already. And after that, we can see that if it's positive, then doesn't matter what happens in the later parts, and also until we have cash reserves building themselves up. So, if these two things positive, then okay, depreciation is here, but we don't want to live from depreciation. I have a friend who had a pet entrepreneur who was building houses, and sometimes he realized that he was terrible in billing. So they were billing walls and buildings, and after that they were not sending invoices to the clients, or clients were let paid with huge delays, but he was always happy to get the VAT repayments from the state, and and my friend was always furious that, come on, you are not living from VAT repayments, from tax repayments, you should live from your clients, so why not doing the billing and then money collection? So that's terrible. So the same thing is that we don't care about depreciation. It's a nice thing, just 34 million euros. This is not the base of our cash flows. It's just a nice additional money. Okay, so we have the free cash flow here. So let's copy the new one. Ding, ding. Oh my. Okay, so we need some. No. Come on. Okay, then 0, 0. Okay, now I was able to put everything in one slide. So at the end of the day, we can see, maybe we can also create a graph to compare with the old one. So we should add an additional line here. So we can see that the old free cash flow will original, the new, because why not? No. I don't want to link them together because this can create just further problems. And instead of using green, let's use gray, because we can see that this is not related to the present company. And then now we can have an image, an idea about the added value, so we can see that this line is higher above than this line here. So also, if we would like to build some fancy thing, then still we should add oh no, so this is millions of euros, so it's not in baguette or other French food. Okay, so as we can see, the free cash flow generate the ability of the company, sorry, to generate free cash flow increased drastically after the second year. Yay! Bless you. So, now we can go towards the VACC. So this is the ugly part, because until here we are able to work from data from the case study, from the profit and loss statement and from annual reports and so on and so on. But here, ladies and gentlemen, we have troubles. So weighted average cost of capital, okay, we have to see that how much share do we have and how many debts do we have. Okay, so this is coming from M20 and M80. Let's see that, are they referring to the right coordinates? M18, yes, M20, yes. And you can see that I was taking up a lot of debt to finance my slight losses. So as a result, you can remember, so we can see the other Excel sheet where I had only 1% of debt from the overall capital structure, and now it's 66% of debt. So, whoopsie. And also that was 99%, now it's just 34%. But you can ask the questions that which one is better for the investor? So if we can say that in many cases when companies are doing such an investment into risky but high growth potential companies, we can have this motivation that they are purchasing, so they are just not providing only the equity, but also they are providing loan. And the motivation can be that in this case, first of all, loan is less risky because if the company defaults, then you will be paid earlier from the liquidated assets than the shareholders. So it's good news, less risky. The second thing, that interest will be paid regardless the profitability of the company. So also from a cash flow point of view as an investor, it's sometimes better to combine both funding channels. So we can say that some of this money can also come from us as an investor. So it's, why not? RD, this is coming from 38. C, 38. C, 38. Yeah, okay, this is the correct one. Just, it's always much better to check before we start to don't understand that what is happening here. So, okay, this is coming from the balance sheet. This is, yeah, this should be defined by us. So, first of all, we have to define the CAPM beta. So this is the CAPM pricing. And this is the So CAPM is the capital asset pricing model which was developed during the late 60s or early 70s, and it's still popular, and it's really good for us because there is this nice guy called Damodaran who developed all the discounted cash flow valuation. And he's a really nice person because he also provides us many different numbers. So if you are interested in any kind of corporate valuation, his website is a gold mine because it's free, and also we can see that total beta by industry, sector, Europe. Then we can download it, then we can open it, and then it opens. You can see that it was last time updated in January. Nice. And then we can check aerospace defense, and also we can see that he collected 61 companies from this sector from the continent. And after that we can think that unlevered beta or levered beta should be used. Which one are we using? I did not disclose it. Nice. Okay, I'm using the unlevered beta because my colleague Daniel Sladek, who is the corporate valuation guy at the department, he told me that I should use this one because it's less biased. So let's write it here. And still we can see... Now it's at the... Oh, sorry. I should use the levered one. Whoopsie. I know that one of them should be used, just 44. Yes, this is the same number. So if we copy and paste it here, then this would be the same. Unfortunately for beta, we don't have any further numbers. So we should keep this one constant. I cannot modify this. It would be nice to have some forecasts at this field, but yeah, okay, so this is the best what we can have here. Okay, then we can ask the next question, that where the market return. Return of the market portfolio. So, and obviously the average market portfolio, this is a French company, so it should be listed at the French stock exchange. So let's go for the Paris Stock Exchange Index, which is the CACC 400. Yes, that's... Sorry, not 400, just 40. CAC 40. What just happened here? Okay, now it's loading it. So this is the weighted return of this index. And obviously we should download it and we can process it. And you can see that already we have one problem because this is from 2023 January. So let's push everybody down with 1 year. Downwards, because now we can have also an additional represent this year. Oh, how can we collect this? In this case, I always recommend this Polish website, stoku.com, because here we have data for free. Sometimes it speaks a bit Polish, sometimes, usually it speaks to us in English, but that's not that terrible. Okay, historical data, and you can download the data in CSV file, so it's really nice, but right now we should look for annual data, show. Okay, this is from December, end of year, but doesn't matter. So, wow, what happened at this last year? Trading day. Cool. So we have this number. Let's add it here. Let's bring upwards. Okay, and now we should modify. Should we modify? No, because okay, and 4. So the time, the lambda is on. Yeah. Okay, so practically here in the first year, 0.98 on the power of 1, then it multiplies the difference, and obviously this is the same because it's multiplied on 1, and this is really close to 1, so it doesn't have any effect. Yep. Then we are rolling it down, so let's check it that, okay, it's a second year, this number, this number, this number, cool, okay. So at the end of the day, if we are summing all this thing up, then we will have okay, 29. Okay, this is 22. Okay, 29. So no, we have to move it downwards. Once. 24. It did not have much impact, but still. Yeah, no. Because, yeah, because I'm just importing the same thing, so I don't have to modify it. So this is much better, because if we just would use annual changes from year to year, you can see that this is so unbalanced. So sometimes we would have negative, sometimes we would have positive change. If we would take just the average, it's also not so good, because information what happened 21 years ago would have the same weight like information what happened in the last year. So obviously we should update this one, so that's why this exponential average can be much more reliable, because it reduces the impact of, for example, impact of the 2008 crisis. So at that time it was big one, but maybe let's not bias today's numbers so much with that. So that's why it's a preferred approach. And also we have the 10-year yields, but this is coming from C39. Yeah, interest on savings, so it's imported just, and 10-year yields. Okay, this is not 10-year yields because it's 1 to 5 year yields, because we were able to collect them dynamically. So otherwise, if we don't have such a data, then 10-year yields are better or still appropriate, because they are not changing so drastically like short-term bond yields. So, but since we have all this data, then okay, why not use it? And after that, we just have to create a calculation. So to this number, we have to add the difference between this number multiplied by the beta, and then we have something which is quite static in nature, but we can see that right now the expected rate of return from this share at this industry should be around this 2.8%. Cool. And then at the end of the day, if we are using this weight of 34%, and there is the 66%, then practically the two capital items, we will have the weight of 5.2%, and then it can increase a bit in the future because of higher interest rates here. Yeah. Obviously, if we will change the funding structure, the weighted average cost of capital will change as well, so it will have an impact on corporate valuation. So right now we are motivated to find the lowest weighted average cost of capital to have the highest valuation for the company. So this is what we will try to achieve when we were thinking about funding channels. But right now we just have to copy it. And there you are. Yes, computers are like plants, so sometimes you have to sing to them and speak to them, because otherwise they are not working as much. Yeah, so in our case, the usage of debt funding to survive the first 2 business years increase the importance. Debt funding and interest rate exposure. And right now we can consider this as a good thing, because ECB started to decrease the key policy rate, and maybe they can also restart their asset purchase program. So at the end of the day, this can be gradually even more and more cheaper for us, because right now it's absolutely not cheap. It's the opposite of cheap. So this 6%, 7%. So we can assume that this will be lower by 1 or 2 percentages in the future if they are running this interest rate path. Okay, so let's compare with the original the sample. With the original one, I have to make this modification here because no. Please. Okay, so again, we have to add additional rows. Then let's copy from the other sheet what I have here. Sorry, date and index value. And then let's add also the exponential thingy. Checking. Okay, everybody is referred to the right place. Are you? Yes, you are too. Cool. Then is this proper? Not completely. Now it's proper. And this one is referring in the right way. Good, good. This did not change at all, so it's okay. Then also we can copy this one. This is percentage, and this should be in italics. So original VACC, new VACC. Here you can see an average of these VACCs, because it will be easier in the future just to compare the different data. But also let's create a line diagram of the VACC, because it can be nice. So now we can see that obviously we are funding the company more expensively than before, because we are using debt. Okay, so now DCF. So after using discounting, so we are discounting FCF, like the present value was calculated, just in this case the interest rate is here in this one, and we are using the time from here. So this is what we have as DCF. Also we can copy the old one. Let's use the same structure. In italics. In italics, no, I don't want. Okay, and it should be gray, and then we can see that this is the original DCF, this is the new DCF. We are creating again a nice diagram. Oh, I forgot to so the DCF is the present value of the free cash flow, and yeah, where the discount rate is the VACC. As we can see, our new business model increased the present value of future cash flows, cash generation, sorry, a lot. So again, this is it's nice to add million euros. Yeah. So we are generating more money than before in terms of even at the level of present values. Good. Then we have still 4 minutes because okay, go sideways. Because after that we can just go through property value. Okay, so let's see that what is the expected value for property in the future. Obviously, here we are just taking the data from long-term assets. I don't care about these investments. I don't know what is the target of this investment, so let's ignore this. In terms of property, we are just using a depreciation for 20 years. So at the end of the day, this property value could decline at this level. So that's why it's in the valuation. Intangibles. In this case, we don't know that which part of these intangibles are marketable, which intangibles are not marketable. Sometimes it's better to ignore them completely, but we are talking about a company which has a huge history in manufacturing, in designing manufacturing equipments. So hopefully their intangibles could be sold on the market. In terms of licenses, in terms of so in terms of some kind of a technology transfer, so maybe they have a meaning and not completely just an artificial way which was generated just to create numbers. So, okay. And of course, what do we like is cash. And somehow this should be relocated because this is disturbing us. So this is coming from our cash reserve. So at the end of the day, this is the happy part when we are not just valuable because of our intangibles, which is huge, but because we have also a lot of money. So at the end of the day, these three numbers are added together, then their present value is calculated. So this is the salvage value. No. This way. Yep. In this case, I will just add years. 1, 2, 2. Come on. 2, 3, 4, 5, and the salvage value. So sorry, the present value of future assets is later. Okay, and this we should compare it to the original. Obviously, in this case, we are not making much money. How could we be even profitable? Okay, somehow they were able to survive. Okay, cool. But we can see that the cash reserves are shrinking, so they will die horribly. So after that, we can see that they are valuable because the intangible things are valuable. So this is the sad reality, which is higher than the original one. As well, let's add it here. As it was dominated only by the present value, tangible goods. So, at the end of the day, what we should see here, the value of the company is this, because if we are adding together the different years DCF and the Salvage value, then we have this new corporate value. So let's forward. And this is where the tricky part starts, because we can see that yes, it was increasing a lot. But also the value of equity will be different, because mostly we were using only equity funding. So these numbers, that's why they are quite the same. But here we have to take all the debt, remove everything else, and then so this number minus 18, which is supposed to be the debt. Yes. Let's copy it this way, so we will have a table. No, not the value of the company, value of the shares. Company and the shares. Okay, and let's remove all these decimals, because it can be absolutely misleading to interpret visually. Space, space, space. Then we can see that even if we used debt funding in the new strategy, the value of equity still increased. Doubled. So in this case we can see the added value, so the difference between the two numbers. So this minus this. Added value of the sample strategy was €. So that was our objective here today, and after that we will start to stress this, that how will it react on the different funding conditions, how will it react on the different approaches when we will try to deal with the exchange rate exposure, what will happen in both cases. And also we should add one more thing next week, the probability of default. So how probability of default can be estimated, and also how will it change. Okay, so that's all for today, and homework.